We are facing drastic changes in the markets. Are you prepared for the volatility that could impact your finances? Discover how to see opportunities amidst the chaos. The Fed is facing quite a bit of criticism lately. Right after their meeting, a very negative report came out that deserved more media attention than the jobs report. This report was the ISM, which showed that in the industrial sector, more jobs are being eliminated. The situation is worse than in September 2008, when Lehman Brothers collapsed. After that, the jobs report came out, making it clear that the Fed is behind and needs to hurry to catch up. Looking at what Austin Goolsbee has been commenting on, I don't think this update will come soon. They will probably have no choice but to raise interest rates by 50 basis points by September 18th. They might even try to act tough. But as the data evolves, at some point they will be forced to act or seem completely oblivious to what is happening. It's a complicated situation. If the Fed announces the rate cut now, it could alarm investors. They might think that the Fed is so worried about the situation that it needs to act as if we are in the midst of a financial crisis. I don't think a slight drop in the stock market is enough reason for a cut. But if we start seeing problems in the credit markets, the story changes. I believe we will see Fed officials leaning towards this in the coming days. And Powell has a rather vague theme for his speech in Jackson Hole this year: how monetary policy affects the economy. He can shape this speech however he wants, and Jackson Hole is an opportunity for that. He might try to convey the idea that the Fed is more active, but he has to be wary of some weighty assistants, like Christopher Waller, who is worth keeping an eye on in the coming weeks. Depending on the incoming data, even before Jackson Hole, it was interesting to see Jim Bullard, who is now the head of the business school at Purdue, saying that a rate cut now would send the wrong message. Unless something related to credit occurs, Powell's biggest nightmare is that the bond market starts to dry up, and that's in the Fed's hands. The stock market is not under their control, but a credit squeeze could force them to act. Today, there were supposed to be 10 investment-grade bond sales, and none of them were priced. And we're talking about investment grade. If this problem spreads to other markets, everything could change. The Fed also released its quarterly survey with officials about lending. They do this because they worry about the amount of credit in the US economy. If a significant portion of the capital market began to shrink and bonds stopped being issued, that would certainly catch the Fed's attention. In late 2018, we had a record 41 days without bond sales, which led Powell to modify policy. And what happened during those 41 days? No risky bonds were sold. And if we start seeing days without issuance in the market, that will surely cause the Fed to act. Look, if you take a look at the revised data, things look bleak. In the 3 months up to September 2023, we lost 192,000 net jobs. And if you analyze the numbers, there were no new hires, with the total being 114,000, even with immigration significantly increasing. Now, the situation has turned. We need to create between 175,000 and 200,000 jobs every month just to keep up with the growth of the population. If we start failing to meet this goal, and the unemployment rate is already at 4.3%, with the underemployment rate at 7.6%, things are complicated. More Americans are working in full-time or part-time jobs, but that's not enough. There's a lot of information that justifies a 50 basis point increase. The reporter asked Jerome Powell about inflation while he was speaking, and he seemed a bit lost about where that might come from. And that's the crucial point. If you look at the true inflation, it's almost 97% aligned with the overall CPI, which was at 1.54%. This indicates that, in the future, CPIs may fall below the Fed's target of 2%, and I truly believe that. Remember, Powell is a lawyer, so he's tuned into other data. And I bet he knows that inflation is not as strong anymore. But the situation is quite delicate. As an ADP economist said recently, if Powell is behind the inflation curve, he won't find it in wages. This is the more subtle side of disinflation, wage disinflation. And that's the real risk now. Moreover, the Fed doesn't have many cards left to deal with this. Food prices are dropping, and that's evident. People are buying less food, and housing prices are plummeting. Look, if we just consider that 47% of the new apartments that started being built in the first quarter were rented, that means 53% remained empty. The biggest factor influencing inflation is declining, and that puts policymakers in a tricky situation, as they've been waiting a long time. They've been waiting since last July, and interest rates are higher than they have been in years. They will have to explain why they didn't take action, and why they also didn't act in July 2024 when all the signs were there. Unless something surprising happens that makes stocks and all risky assets rise at once. If corporate America stopped doing crazy things, like Intel, which took an $8.5 billion loan and then decided to lay off 20,000 people, maybe things would improve. What people are doing now is cutting jobs as if there were no tomorrow. In the last 6 months, about 1,000 CEOs have been swapped out. And this is happening because they want to replace workers with AI or simply eliminate positions. And we hear this every time we're on earnings calls. The way companies make their stock prices go up is by firing people. If the S&P 500 falls 3%, the MSCI Emerging Markets Index drops for 0.2%, and the Mexican peso gets hit hard. Anything related to the carry trade is being blown up. And there's something nobody is talking about that is super important. The Bank of Japan cut its quantitative easing program in half. They're injecting money into the global financial system, and that system loves liquidity. When you cut that in half, and they're the last ones to do quantitative easing, the markets will not react well. You can't measure the size of this risk. The real big risk is the parity. There are certain strategies in the stock market that, if they start to crumble, along with the carry trade, can cause a cascading effect and destabilize credit markets. One of the things we are seeing in this earnings season is companies failing to generate revenue. You can do accounting magic to show profits, but we are witnessing companies one after another struggling with their sales. And that is a sign of recession. That's how we know a recession is coming, when sales plummet. And that's exactly what we are facing currently, with red flags appearing. Historically, stock markets do not recover until the Fed starts cutting interest rates. That's the reality, until the yield curve completely inverts, which happened today for a time and made markets nervous. Stock markets usually do not correct. It may be that there's a shakeup here and there. Last week, we had a day when the Nasdaq 100 rose 5%. Today it fell a bit. But remembering what happened in 2000, before the market collapsed, the volatility in the charts was insane. And that's why we're seeing increasing volatility. Be prepared for a scenario of significant movements, because if you're not in the know, you will miss the opportunity. At the beginning of the day, the VIX jumped to its highest level since the 90s. It's crucial to be positioned to take advantage and profit when risk assets correlate and drop all at once. Today, the only thing that appreciated was gold. It's important to analyze gold's history, as even in periods of disinflation or deflation, when a financial crisis occurs, it tends to perform better. You also see central banks around the world buying a lot of gold. That's what investors usually do, seek insurance because they feel that, after so long without problems, their houses could catch fire at any moment. And that's when gold truly shines. serving as a protection for the rest of the portfolio. We know that many margin calls happened at the beginning of the pandemic. Gold struggled at first, but only for a time. It fell because if you're holding a stock and get a margin call, you need to raise money quickly. Hence, that's why gold held up better than other asset classes. It's good to be cautious when looking at housing price data. Normally, they reflect the scenario from 3 months ago when we were in spring sales months. There was a lot of hope at the time, and sellers were more realistic about prices. Now, however, the situation is different. People in the real estate sector are surprised at the speed of the increase in inventory. Now, we have a growing number of American cities with more properties available than in 2019, and this could quickly become a problem. That's why the reaction to consumer confidence data was greater than to housing prices. Housing prices are not such an urgent problem for the Fed because we know that the real estate market is weakening enough that in a year we will be discussing the risks of disinflation in housing and how that might impact inflation as housing prices fall. And that's what is coming, given the rapid inventory increase. On the other hand, many of us consumers are hoping that everything will be fine. It's interesting to note that Americans' perception of the economy and how businesses will behave in the coming years has dropped significantly. Even so, many still think, from me, things are a bit risky but all good. We are at a delicate point where if my neighbor loses their job, we will enter a recession. And most Americans and surveys are showing this now believe that we're already in a recession, not heading towards one. When I talk about more conventional surveys, 52% to 56% of Americans think we are already in a recession. But it's okay as long as you're just talking about your neighbor. But that old saying goes, if your neighbor loses their job, you're in a recession. If you lose your job, you're in depression. And for now, we haven't reached that point. Job losses are still not widespread enough, but we are moving towards that, especially since the confidence of CEOs and CFOs is not improving. It is basically stagnant, which means they are still cutting costs. So, in this upcoming earnings season, we may see another wave of layoffs in corporate America. And I think we are reaching a stage where this may impact more than just your neighbor. What we're observing is, in one word, momentum. Layoffs are being announced in months that typically don't have this kind of activity. April shouldn't have seen more layoffs than January. But that's what occurred in 2024, which was quite unusual. When things begin to deviate from the normal seasonal curve, you typically see an increase in unemployment during the summer. You know how in Detroit they close auto factories for a few weeks? That creates a seasonal pattern and weakness in July. But the magnitude of the layoffs we are seeing now is concerning. It's like when a logistics company in Humble, Texas, receives a message on a Thursday afternoon saying that the company, which was controlled by private equity, is shutting down and you won't receive your payment on Friday. And that only affected 2,000 employees. It's when this sort of thing happens, and it has happened recently, that we begin to see cracks in the structure that are not just part of the normal business cycle. I believe many people on social media enjoy critiquing Powell, taking swings at his pea Potter because it's a fun sport. It's easy to compare him with his predecessors. Janet Yellen was so fearful that she avoided going to the podium. She didn't want to speak to anyone in Congress. Ben Bernanke was also sometimes shy and not very politically savvy. Alan Greenspan, on the other hand, loved to interact, especially with presidents. He was always in the limelight. Now, Powell is the exact opposite of all of them. It's a matter of public record, but he has been meeting with more congresspeople from both parties than any of his predecessors. He has been very active in talking to representatives about what their constituents are feeling. And it's not a matter of being political. In fact, it's the opposite. During one of the press conferences, He was directly asked if the data was weak enough to justify action in September, and if it would interfere with the FOMC meeting before the election. It's rare to see Powell deviate from the script after Fed meetings, but suddenly a dark cloud crossed his face, and he declared, "Every meeting is live. Every meeting is live. Policy will not change that." Exactly. Powell is a different character. If we start to see a gradual increase in the unemployment rate, just like in 2007, when it turned into 2008, and it rises slowly, a tenth at a time slowly then, boom. In early 2008, there were significant movements in the unemployment rate. If we are in July and August, we might well see the first rate cut happening in September. In scenarios like this, where you have the year 2000 and 2007 converging, we are dealing with both market overvaluation and excessive debt. American household finances are in a critical state. It's not just mortgage debt. Currently, the average American family is spending more on interest from non-mortgage debt than on mortgage debt. This is a sign of extraordinary times. With such a dynamic, we know that the markets are overvalued. You can ignore many graphs, except for the one showing that the top 10% of the stock market is more concentrated than at any point since 2000. And now, even since 9, that truly draws attention. Do stocks matter? Not really. It's not until the Fed actually cuts rates that someone on the trading floor starts to get worried and thinks, "Oh, the Fed thinks we are in a recession." That's the only moment when traders will actually pay attention. They will worry, and everything will happen. But none of this matters until someone says, "Give me an economic calendar. The Fed just cut rates. What's happening in the economy?" Until that point, most will continue to speculate. Historically, it has always been this way. If the Fed cuts rates in September, then the stock market does what it normally does and crashes. The narrative will be that Powell is trying to influence the election intentionally, and he will probably justify by saying, "The unemployment rate has risen, and the unemployment rate was already at our target of 4.0% in May, 7 months ahead of schedule." Are we paying attention? Yes, but nobody will approach it logically. My Twitter feed will probably fill up with criticisms and comments like I said he would cave to anyone. And you can't just have a carefree conversation with someone who is thinking about retirement. Like, I'm about to turn 60, and I'm thinking about where I should be now. To which you might respond, "Well, that depends on how serious you are about retirement and how exposed you are to the stock market." And the person replies that everything is invested in stocks. Then you say, "Maybe we should rethink that strategy." And many might think, "Oh, this will come back in a few years." But the truth is these cycles don't follow a set timetable. We only know how things behave at certain times. Exactly, if you are in the mortgage industry, it's evident that things are slowing down, and that is a clear sign that the economy is cooling off. So, you try to be as cautious as possible and suggest, a few months ago, were you still into Bitcoin? Why not take that off the table and invest in the Nasdaq? After all, the unemployment rate isn't where it should be for the Fed to start cutting rates now. So why not shift your bets? Take your money out of Bitcoin, which has all that volatility, and put it in the Nasdaq just for fun. Let that ride and consider the rest of your portfolio. To be honest, now is not the right time to be in the stock market if you really want to retire in 2 years. If you are younger, like someone in their 30s, the approach could be different. But where you are in your career is crucial at this moment, especially with graphs circulating comparing the current market concentration to 1929. These are alarms that should draw the attention of the average citizen if they had any civic education in high school, of course. The situation requires caution and strategic planning, and disregarding these signals could be a costly mistake. If you liked this content, Don't forget to like, subscribe to the channel, and activate the bell to stay updated on all the news. Leave your comment below. How are you preparing for market volatility?